So you mentioned that you believe you believe that 2023 could potentially be the end of the Fed hiking cycle, but isn't that dependent on the inflation numbers? Do you believe that we've already peaked inflation, and is it coming down? And also to add on top of that, right, you're starting to see articles by the legacy mainstream media. There was an article by the Wall Street Journal, and trying to attempt to normalize, the way that they advertise is like, we don't really need 2%. We need 4% inflation. So do you think that if they do get it down to 4%, that's good enough for them? They'll start trying to normalize that moving forward. And the first part of the question was, is the end of the Fed hiking cycle dependent on if inflation is in fact under control?
So yeah, a couple different questions there. I'll try to go through them. One is that I do think we're at the top of a local peak in inflation. The way I've been framing it, and this is before inflation rolled over, is that I think that just like the 70s and just like the 40s, that this is going to be an inflationary decade, but that doesn't mean you just constantly go straight up. You often have periods of disinflation, cyclical disinflation within a structural inflationary environment. And so usually it's because there's attempts at counterattacks, right? It could be Fed tightening, it could be price and wage controls. There's basically various kind of pushbacks that these top-down planners can kind of do against those forces that work for a period of time until something breaks and you have to change course. Yeah, and so it actually, if anything, came about a quarter later than expected, because starting at the end of 2021, I was predicting that around quarter two would probably be the peak in inflation. I think the Russian war added like a quarter to that. It kind of stirred things up a little bit more than the otherwise would have been, and so we got the peak in quarter three, and now we're rolling over. And I think as long as, it kind of comes down to how quickly China reopens. If they just tomorrow say, "Hey, we're going to go all out. We're going to completely reopen. We're going to give everyone, $1,000. We're going to promote like flights and travel and other fuel intensive things." You could get a major breakout in oil, for example. And that's obviously an extreme example that just shows how, some decisions can influence this. But essentially, I do think we're in a disinflationary environment, at least in the maybe first half of this year. I mean, next year, like 2023, maybe throughout the whole year. Where I would get concerned about another wave of inflation is maybe 2024, 2025. Next time when we kind of enter like another growth period, and that kind of goes back to the Fed. I do think if you got an inflation drop down to say 4%, I think you'd have more questions among Fed officials. I think some of the more dovish ones would be in favor of kind of loosening policy, especially if economic growth isn't very good or is an outright recession. Some of the hawks might still stick to it, though, because, for example, it seems to be the case that Powell has tied his legacy to his ability to get inflation back down. And so I think that he might be stickier than some of the others. But I certainly think that as it gets lower, that raises some questions. But it really comes down to what else is happening, right? So 4% inflation, if the economy is very strong, they can still justify raising rates more. On the other hand, if it's 4% inflation, but they're in a unmistakable recession, and they have like Congress breathing down their neck, and just rising problems, or if they have some sort of problem in the treasury market, due to illiquidity, then that's a different discussion. Then they might have to do some sort of, a different approach, and kind of reject liquidity into the market, despite the fact that inflation is above their target. I think that the overall end game, kind of later in this decade, is that they are going to be forced into a corner where there's inflation, and they're stuck adding liquidity to it, basically to finance kind of, to monetize government deficits. So it could be in the form of yield curve control, deficit monetization, kind of, another round of QE, kind of like what we saw, I think, as a microcosm of what happened in the UK. So they had 10% inflation. They were talking about reducing their balance sheet. And then they had this awkward period for a few weeks where they had to, buy gilts. They had to buy UK sovereign bonds to bail out their pension system. And I think you could see rounds of that in the US. Maybe not right away, but I think that that will be something that happens, here in the 2020s.
So you said something interesting, which was the that I literally miss. Oh, there! I literally highlighted it. inflationary decade, you believe there's going to be an inflationary decade. Last time that happened in the 1970s, the stock market was relatively flat as well. Do you believe that is going to happen? And are does this mean we're finally going to see a decoupling? Are we going to finally see a decoupling from traditional assets, right? Because Bitcoin has been highly correlated so far.
So both in the 40s and the 70s, you had commodities do better than equities. Equities were kind of range bound, as you pointed out. In the 70s, in large part, that was because, if you had interest rates that are double digits, that goes back to my prior point where what is the fair value of an equity? If you can get 10% on treasuries, you probably have to price the equity in such a way that you can get 15% or more returns, which means paying a very low multiple. And so you basically had nominal growth from inflation of earnings and things like that, but then it was offset by valuation reductions. And so you got this big flat, choppy pattern. In the 40s, it was different because, due to how high debt was, government debt, the Federal Reserve did yield curve control. So they kept interest rates low despite the fact that inflation was high, and yet you still had equities be very range bound. Now, obviously, there's other factors. Investors had to price in like the probability of winning or losing the war, for example, and the market basically bottomed as soon as the United States started making major victories, like after the Battle of Midway, for example, when they really kind of turned the tide on Japan. And so there are other factors that always make these things complicated. But overall, if you have an environment with negative real yields, equities can still probably do okay. Whereas if you have high nominal yields and high real yield, that puts a lot of downward pressure on equities. So overall, my expectation is generally that we won't see great performance out of equities over the next decade. I think that the prior decade was this big gain. It was very disinflationary, which was very good for corporate profit margins. But I think now they're going to have higher structural wage pressures in many cases, and I think that's going to just challenge overall profit margins, and they're likely to face some degree of just valuation compression and kind of trend sideways, at least in real terms, right? So I mean, if inflation's bad enough, like if you look at an emerging market equity index, they'll generally be doing great in nominal terms, local currency terms, but they'll be doing sideways to down in dollar terms. And so I think you could see something like that in the U.S. where if you do kind of by the end of the decade have runaway inflation and some sort of Fed repression and yield curve control, you could get a nominal breakout in equities. But it wouldn't necessarily be a good breakout in real terms. So I think my higher conviction case is a long period of sideways chop, at least in real terms, and probably for a number of years in nominal terms as well.
Interesting.
And as for decoupling, yeah, I think so. Basically, inflationary decades are very good for commodities, basically things that are scarce. They don't have margins. So gold, oil, copper, silver, Bitcoin, things like that. Bitcoin, the challenge there is that it's still perceived as a risk-on asset in large part because it's just not well understood. It's not widely held, and it's often leveraged because of its upside potential, and so that creates downward explosions. Um, so I think it'll still probably be correlated to say the PMI cycle for quite a while, meaning it's generally going to do better in risk-on conditions and worse in risk-off conditions. Um, but I do think that it can, if equities go sideways for that decade, I do think that Bitcoin can keep grinding higher, even if it's still often correlated on a day-to-day basis, more often than not.